Talk Money to Me is a financial podcast produced by TransGlobal. All opinions expressed by the host and guests are solely their own opinions and do not reflect the opinion of TransGlobal. This podcast is for educational purposes only and should not be relied upon as basis for investment decisions.
Hey everybody, welcome to Talk Money to Me, where we talk about money and how it affects you. I'm your co-host, Jonathan, and I know a little bit about finance.
And I'm your other co-host, Tracy, and I know almost nothing about finance.
We have two wonderful guests with us today. I'll go ahead and let them introduce themselves.
Hey everyone, I'm Daniel. I am a financial advisor, and thank you guys for having us back on the show.
Of course.
Hey, it's Stephanie, and I am a personal finance enthusiast.
So this is part 2 of Intro to Credit. First off, I wanted to ask about the types of credit that got mentioned last time. There were installments, revolving, and open credit. I was wondering if you could go into a little bit more detail about what those are.
Yeah, of course. The first one is installments. You have a set amount of money that you pull out, a lump sum that you kind of like borrow, and then you have to pay that amount over time, accrued with interest. So that's usually like home mortgages, car loans, student loans. So those are common examples of installment credit. And then the second one is revolving, which is like the credit cards. They'll give you a credit limit and you can borrow up to that credit limit. And then you can also pay off. It goes back and forth. You can pay off, borrow, pay off, borrow. And then open credit, the third one, is a kind of a mix between installment credit and revolving. And an example would be like utility bills. So you don't really have a limit like revolving, but you do it based off of how much usage you have, and then you would pay off that usage at the end of, your billing period.
I think one good way to identify these kinds of credits too is by looking at how they charge you for having that kind of credit. So for example, like an installment credit, if you're taking a lump sum and you're paying it down, usually that interest rate is like a single digit number, like 3, 4, 5%. Whereas revolving credit, like credit cards, usually like double digit, 10, 15, 20%. Open credit usually charges you a fee if you're late. That's like kind of a rule of thumb of how to identify. If maybe you're looking at a bill and you don't know what kind of credit this contributes to, look at how much they charge you if you're late.
But what if you're living at home and you don't have a mortgage or you don't have utility bills right now that are in your name, and you just have credit cards? Is there any other ways to get a good credit mix? I was thinking about like other types of installments. For example, sometimes I want to buy something that costs $3,000, like a laptop or something, and I decide to pay in installments. Does that count towards my credit?
No, unless you're delinquent and that lender, the person that lent you the money, they're like, hey, you're not paying your money, your payments on time. We want to report this to the credit bureau, and then it can actually negatively affect your credit in that case.
So what you're saying is that these installments are like an Asian household where you get grade. If you get an A, then it doesn't count. But if you get a C, then you're disowned.
Pretty much. Very good example. Very fine example.
Yeah.
I know that also last time we had talked about one of the big things was making sure that we pay our bills on time. So that's something that we can all definitely start doing. Is there anything that we might need to stop doing, or even if there's some habits that we've already built up that we should keep doing?
It's hard to define between start doing and stop doing because they kind of go hand in hand. One thing that you should definitely stop doing is stop overspending. Like don't spend more than your credit card limit, or don't spend more than you can pay off on your credit card. But that really does go hand in hand with creating a budget. We have another episode that goes specifically and in depth into how to start setting a budget. Another thing that you should never do is don't close credit cards. Don't go out if you have a card that you don't use a lot. Just because you don't use it, don't close it down, and try to at least swipe it once every like 3 to 6 months, because credit card companies will sometimes see no activity and then close down a card that you might not be using. But what happens then is you lose that little bit of credit limit that card was offering you. And remember, last time we went over, we want to have as much credit limit as possible and use as little of it as possible. Don't open credit cards at random. Don't treat it like free money. I think that some people actually need to hear that.
As a representative of one of the people who thought that credit cards were free money and then ended up in a lot of debt, I think that some things that I learned, and I really like what you said about the stop and start doing being hand in hand, right? I had to stop overspending, but before I could do that, I had to start having a budget, right? I had to stop like closing unused credit cards, but before I could stop like just wanting to close them, the reason why I wanted to close them is because I was worried that I would accidentally spend on them. So what I needed to start doing was to be more cognizant of how many cards I had and what the purpose of each card was. And so yeah, or I just had to cut them up. Yeah
that's definitely a good way. Instead of like closing the card, put it in a shoebox under your bed, or hide it away, or just straight cut the card.
Do any of you guys know anyone who actually froze their card in an ice cube?
Did people do that?
I have heard of that before. But
that used to be a thing.
Really?
It was. I know I had friends who would freeze it, and it was their emergency when things were super, super bad. But it helped them to also budget too. People do extreme things to make sure that they stay on track.
What I've learned also is that there is something called a credit game. We can maybe seize our credit cards and start making them work for us. Is that true?
I like the credit card game. I've gotten a lot of money, cash backs on it, but for me, it's like, I know everyone's different. Both me and Daniel talked about this. Like, we kind of evaluate which credit cards we get. I will look at annual fees and then the APRs.
What does APR stand for?
So APR is annual percentage rate. So it's pretty much the rate at which your interest will accrue if you don't pay off your balance. Not just the minimum, but the actual full balance. The reason why, I recommend for the common American to look at your annual fees and then your APR is because, if you can't be paying your statement off fully every month, you need to remember that you're going to be accruing interest.
I don't look at APR as much because from my point of view, you should never try to fall into the trap that, oh, I know I'm going to pay this APR, right? But that's what kind of budgeting hopefully will help you reach, that you won't have to hit that APR because you won't overspend on your credit card, right? And that's kind of the goal of managing a lot of credit cards, or managing even just your credit score in general, making sure that you're staying within limitations and not having to pay that APR. Most people like games that they know, or if they're good at it. And Steph, you said that you've earned a lot of money, you've gotten a lot of perks from credit cards, but a lot of people, like Tracy included, may not have a good experience with the credit card game.
Hey, I'm in a healing process, okay?
See, no, but you're getting better at it, right? You're getting a lot better at it.
I point out earlier when you guys were talking about your differing views about approaching credit cards, right? I think that as with most questions in finance, the answer is it depends on you.
It definitely does.
Right? We understand that not everyone has the option or the privilege of being able to say, I'm going to get a credit card just to build my credit, and I'm never going to overspend because I have enough money to never overspend. I think some people absolutely need to get credit cards because they do need more than what they currently have. If that's your purpose for getting a credit card, then absolutely you need to look at APR.
Absolutely.
Right? You're going to need to pay it back over the course of several months rather than just paying it off this month, then you're going to want a card that's not going to overwhelm you. And I think a question that a lot of people have, and I want to see if you guys can answer this, is what do you do when you are in a situation where you have a credit card that has a crazy high APR and you're having a lot of struggles paying it off? What are some of your options for that situation?
That's a very good question. I think one of the best things to do, or to put simply, is use a credit card to pay a credit card, right? And a lot of people think that it's like, oh, well, what about the APR on the new credit card? Well, most credit cards will offer you like an introductory rate of 0% for the first year to 6 months. So you're buying time for yourself. You may not be able to pay off the full balance, but at least for a year to a year and a half, you won't be worrying about the interest growing, right? You can do this through what's called a balance transfer. Most credit cards will charge you for this, and they'll take a small percentage. They'll charge you a small percentage, but it's better than paying, if your credit card's charging you 25% interest rate, it's better than paying 25% year over year as that interest grows. And the second thing to do is if you are in need of using a credit card and exceeding your limit or exceeding your monthly expenditure, maybe don't look at a credit card, but maybe look at a personal loan. Right? Because personal loans at banks usually will charge you around 6 to 7%, whereas the lowest credit card interest rate that I've seen is like 11%.
And just as a recovering credit card addict, I'd like our listeners to know that 11% is crazy low.
Very, very
And most
low.
of your credit cards are going to fall within the 20% range, which means that if you don't pay off your credit card, you are paying a lot on the balance that you have outstanding.
Going back into the credit card game idea, a lot of the common things that we'll see is a ad about cashback, and then you'll also see an ad about points. Sometimes you'll see both. What are the differences between those? Is there a better or worse depending on your situation?
In terms of level of difficulty, I would say get a credit card first. Learn self-control on how to spend on your credit card without going over your limit. Start looking at cashback. Some credit cards will offer you a signing bonus. If you spend a certain amount of money within a certain time period, say $1,000 within the next 3 months, they'll give you $300 back. And that sounds like a great deal. But what if I say, hey, look, I just got a credit card that I had to spend $1,000 on. I'm going to buy a new computer. But I didn't have the money. I wasn't planning on buying a new computer anyways. Well, I still have to pay for that computer on that credit card, right? Try to make sure that if you want to take advantage of those signing bonus offers, those cash bonus offers, try to move expenditure from one card to another for a short period of time to take advantage of that. Don't create new expenses just so you can get the benefit.
I learned this the hard way, but whatever amount the credit card wants you to spend to get the full bonus, right? It has to already have existed in your budget.
Exactly. And then moving on to the next level, I think annual fees doesn't necessarily always have to be a bad thing. Some annual fees will also offer you more bonus than its free counterpart. So, for example, I've opened a Capital One Saver card, and they have two kinds. They have one that's free and one that costs $95 a year. The benefit of this card is that it gives you very good cash back on restaurants if you swipe that card at restaurants. I eat out a lot, but however, when I signed up for the card, the free one only offered me 2% cash back, whereas the $95 one offered me 5% cash back. I did a quick math and I realized that based on how much I eat, based on my budgeting, and how much expenses I spend in a month, I could pay that $95 would be paid within like a month or two of me using the card. So this is why it's another tier above just using a credit card or just looking for points. You have to kind of take into account and be conscious of, is what you're paying worth what you're getting from the card?
Yeah, I recently had my perspective on this completely changed. So basically my understanding is that cash back is a percentage of your spending on your credit card is directly credited back to your credit card. So for example, for every $100 you spend, you get $3 back. And so you only spent $97. Essentially, that's how it works, right? So whenever you see ads that say 3% cash back, 5% cash back, that's generally how it works. And it's actually probably the safest option because it's a direct ratio, right? If you're not someone who is pretty credit card savvy or already knows your budget really well, I would say go for cash back, right? Because otherwise it's going to get complicated. And the reason it's complicated is because ads that say points, right, means that they're going to, those points are not cash. Those points are assigned a value by whatever credit card company that you're getting it from, right? So for me, I have a lot of Chase cards. One of those cards is a Chase Sapphire Reserve, which gives me a lot of points on travel. And this is something that I was really reticent to do because I was under the opinion after having a ton of credit card debt that I should never ever get a credit card with annual fees, right? Because that would never ever be worth it because I don't want to pay to pay. So that's what I thought it was. But my friend pointed out to me that with the 3 points on travel and with the amount that I travel, she actually made me realize that I would be saving more than I would be spending on this annual fee with this card, right? So I think that there needs to be no fear towards it, but there needs to be homework.
There needs
right?
to be homework.
I think that if you are willing to do a lot of homework, then yes, get into the points game, right? But if you're like, man, I just want to make a little bit of cash back so that I'm not making zero cash back, then do something simple, no annual fee, some basic cash back, and you'll be good to go. Not to over harp on a point, but if you don't know how you normally spend your money, then there's no way you can even consider the credit card benefits.
Definitely.
Because it's gonna make you tempted to spend your money in a way that you don't normally spend, which will take you outside of your budget, right? That checkout line at Macy's is going to make you want to buy 3 more outfits that you weren't planning to buy to get the most savings. But that doesn't actually save you money if that wasn't ever part of your budget. I travel several times a year, which is why my Chase credit card works really well for me. But I wouldn't recommend it to all of my friends because I know not all of them travel. And so it's going to be wasted on them. And they're going to be wasting a ton of money on a huge annual fee.
Thank you so much, guests, for coming in and giving us a deeper dive into this. With that, this brings us to a close. Thanks again for listening to Talk Money to Me. We'll catch you at the next one. Bye.